I'm Stephanie Sievers, and for the last 10 years, I've been working with Dr. Jeffrey Hewings to provide our members and the public information on Illinois housing stats. The first half of the 2021 housing market has been unlike any other. We recently sat down with Dr. Hewings to talk about what's happening in the Illinois housing market now and get an idea of what to expect through the end of the year. He'll also share information about changes to the forecasting team and introduce you to Dr. Dan McMillan, who will be taking over next month. Welcome, Dr. Hewings and Dr. McMillan. With everyone watching for trends in the housing market, you created a 6-month forecast looking through the end of the year. What can we expect in terms of home sales and prices?
We have been looking at the next 6 months to see what is likely to change and what is likely to stay the same. And essentially, our analysis reveals that the continuation of the current trends is probably the most likely outcome, with the exception that we'll see the usual end of the year decline in sales volume. This happens almost every year. And price changes will probably mute a little. They will still be positive, but they will not be as large as they have been in the early and mid parts of 2021.
Is the market cooling, and what is happening in terms of consumer sentiment about the market?
The market is, I think, remained relatively hot, to use the current term, and consumers seem to be remaining positive. But what we've noticed is that the media tend to jump on a single month. And if they see something going down a little, is this a doom and gloom indication that things are going to decline rapidly? But I think the most interesting part of the market right now is this enormous gap between consumers who are interested in buying and consumers who are interested in selling. And there's a gap of around 14 percentage points, with those who want to sell feeling much, much more optimistic about the market than those who want to buy. And on the other hand, when we look at the non-housing part of the market, we've seen in the last month a slight decrease in consumer retail spending, but this probably reflects the fact there was an upsurge, and that is unlikely to be maintained, and consumers are going back and behaving, if you like, whatever we call as more normally. And the only difficulties that they are noticing is that there are huge inventory problems for things like consumer appliances. And we've been reading a great deal about the problems with chip availability for new car production. But apart from that, I think the market is reasonably stable at this time.
Monthly sales totals can fluctuate. What should we take away from a 1-month decline?
I would be very hesitant to extract any long-term trend from a month-to-month change. And if it is, it's a very small change. A 1% decline is not dramatic. If that continues for the next 2 or 3 months, then I think we might begin to talk about a market that is beginning to cool. But I think we have to be very cautious because, as you know, when the data are recorded, sometimes there's a lot of activity towards the end of 1 month that sort of dampens the activity for the following month. And so looking at longer term, I think, is much more important than looking at a month-to-month change.
How does the 2021 market compare to 2020?
The market in 2020 was probably the most crazy of the 14 years that I've been looking at this, in the sense that we had this enormous downturn in March and April, and then it just went off and grew at an enormous rate. The one major difference is that the inventory was much higher in 2020 than it has been. And what we've seen is a continuation of price increases, a continuation of increases in sales, but a significant decrease in the inventory levels. And I think this is probably one of the major concerns in the market right now, so that if sales begin to decline, it may not be an indication that people are softening about their attitudes towards the market, but they've just become a little frustrated that they can't find properties that they want to buy. The amount of variety available is not very high. And I think this is a real concern. One of the things that I think is interesting about this market is that with low interest rates, you would expect a lot of demand. And that is certainly being the case. But a lot of that demand is coming from people who are refinancing. And over 50% of mortgages that were issued last month were refis. The other aspect of this is the sort of interesting, that's sort of accelerating the demand, is the fact that Fannie Mae has now announced that in any underwriting decisions in the future, they're going to take into account an applicant's rental history. And if they've had a very good history, that will result in them getting much higher ratings. So this is a real incentive to attract more people, and particularly renters, into a market which is already suffering from very, very tight inventory.
Available inventory has steadily declined over the last few years. What's causing that decline, and when can we expect inventory to improve?
I think there's no one reason, but I think probably the most dramatic thing that has happened here is in contrast to when we came out of the 2008-2011 recession. We had as much as 18 months of inventory on the market in any one given month. And that took a number of years to remove. But we were already beginning to see tight inventory at the start of 2020. And so this has been a continuation of the trend where the inventory rates over the last year have declined anywhere from 30 to 50% from already low levels to even lower levels. And so I don't think there's any expectation that this is going to change very much over the next 6 months, because the supply of new houses is dampened. We have a lot of people who become risk averse, and they don't want to enter the market right now. And even more importantly, I think we have a lot of people who are looking at the market. They want to maybe upgrade the house. They want to move to a larger house or to a different location. And they just don't find the variety of properties that they want to move to, so they're staying put. And so all of these things are dampening the supply side, but the demand side is continuing to grow in terms of demand. And so this is putting that tension, which is probably largely responsible for the uptick in prices.
Available inventory has fallen as low as a 1.7 month supply statewide. What's considered a healthy supply?
That's a question that I really have not thought about as I say, oh, if we get to this level, it's healthy. But when I look back at the last several years, it seemed to me that somewhere between 3 and 6 months seems to be a sort of a comfortable level. But the problem is that you've got different availabilities, even during those times, in terms of price points. So one of the things that we're noticing right now is for properties over $700,000 in Chicago, you've got an inventory which is 4 or 5 months in length, whereas the overall inventory for Chicago is 1.7 months. And then when you look at the lowest priced houses, you have inventories of 1.1 months. And all of those rates are about half what they were this time last year.
Is the market seeing different trends at different price points?
Not really. I think when we look at the price points, I think the inventory problem is pretty similar. It's 1.2 to 3.4, which is not a humongous range, except for the highest price, where they are around four months. But these inventory levels, I think, reflect a couple of real concerns that the price escalation has essentially removed a lot of properties from the lowest level. And so that you've got two problems. One is the supply has shrunk because people are not putting their properties on the market, but the values of those properties has increased, so that the house that was 180,000 is now 220,000. And this is really going to dampen, I think, the ability of a lot of first-time buyers to enter the market, because even with low interest rates, they may not be able to qualify even for one of the lowest priced houses. So that makes it very, very difficult for new people to enter the market. It's good news for people who want to sell their properties, because they're getting much more than they anticipated. On the other hand, for new entrants to the market, it is dampening their ability to effect a transaction.
With forbearance agreements and eviction moratoriums coming to an end, what could that mean for the Illinois foreclosure activity? Is there a backlog of foreclosure cases that could impact the market? And how might that compare to previous foreclosure spikes in years past?
We've been monitoring the foreclosure activity, and in the last 6 or 7 months, the inventory has begun to rise again, but it's way below the levels that we saw at the end of the Great Recession. And certainly, given the legal procedures involved in Illinois, even increases in foreclosure filings will not result in properties coming to the market perhaps for several years. I mean, it sometimes takes as long as 6 years. The other aspect of this is that a lot of people are very concerned about the forbearance requests. And last month, the Mortgage Bankers Association announced that they had been declining for the last 19 months. And in June, they had dropped below 2 million. And the interesting question here is, what about those that are remaining? How many of those are going to be solved satisfactorily with a renegotiation, perhaps renegotiation of the mortgage length or the mortgage rates? Or will they end up going into that foreclosure inventory? And that's unknown. We don't have any information about the characteristics of those properties that are still currently in forbearance. But clearly, I think the inventory problem is not going to be solved by an increase in foreclosures, especially in the short run. I think it was just when these finally get adjudicated through the legal process and they come to market. And that's very difficult because one of the students we had employed made this a focus of her dissertation. And there was enormous variance in the time, but it seemed that 6 years was sort of the upper end of the range, and 4 years was something around the median for these activities. But some of them were adjudicated very quickly. Others took even longer. And so trying to forecast the length of time they go through the legal process is very difficult. And as you know, last year, a lot of legal activity was halted because the courts were closed. So we may have a backlog coming starting through the process, but it's really not going to make a significant difference to the inventory over the next 6 to 9 months.
Finally, the University of Illinois forecasting team will be transitioning from its original home at the Champaign-Urbana campus to the Chicago campus under the direction of Dr. Dan McMillan. Dr. McMillan is the head of the Stuart Handler Department of Real Estate at the University of Illinois Chicago Business School. Dr. Hewings, can you talk to us about that transition?
First of all, after 14 years of doing this work for you, we wanted to explore an orderly transition to a new team while trying to retain the opportunity for Illinois Realtors to work with the University of Illinois. And while it has been my great pleasure to oversee this service, I just want to thank you for your support that has underwritten the research careers of many University of Illinois graduate students, many of whom are now enjoying careers in academia, in the private sector, and the most recent one with the Federal Reserve Bank of Richmond. Their access to the housing data has been instrumental to their successes. We are therefore delighted that Professor Dan McMillan has agreed to lead a new team from his base in the real estate department at the University of Illinois at Chicago. Dan is one of the world's leading urban economists, and over his career, he has focused a great deal of his research on the housing market in Chicago. The new team of research assistants is already in place, so let me introduce you to Dan, who would like to say a few words of introduction. Dan?
Well, thank you. I want to thank Jeff and all of you for the opportunity to do this. Yeah, I've been at the University of Illinois since 1999. I'm one of the few people, I think, who spent time back and forth between the two main campuses. I spent, let's say, 1999 to 2008 in Chicago, and then I was back in I went down to Champaign-Urbana until 2018, and then I've been back since 2018 in Chicago. where I got the opportunity to head the new Stuart Handler Department of Real Estate, which was formed at the University of Illinois Chicago. And one of the things that we really wanted to do at the new Department of Real Estate at UIC is to develop a program and a reputation that's based on Chicago area and Illinois research. So I just think this is a wonderful opportunity. What we're going to be doing is having a major in real estate that we hope to attract quite a few students from the College of Business. And it's going to be a Chicago-focused curriculum. And so I think this is a wonderful opportunity to, have this sort of practical experience in monitoring the market that will help with our program and hopefully allow us to help the Illinois Association of Realtors also. We have 5 real estate economists in our department. I'm the most Chicago focused of them, but they all have a strong interest in Chicago area research. I'm really looking forward to continuing this. So yeah, I'm really excited about the opportunity. I want to thank Jeff and everybody for allowing us to do this. And I look forward to working with you.